it's a pretty shining rock that has withstood the test of time.
What is like a perfect investor? Do you guys buy companies?
We do a lot in the private credit space, so a lot of money chasing it, with the end result of being standards, covenants have really deteriorated.
Gold actually is currency in a lot of places. China and India, two of the absolute largest cultures in the world by population.
Most investors who are buy and hold, and it's an allocation, they have to think of their stocks as a volatile asset. Some of them shy away from gold because gold is volatile.
We all of a sudden open the room, the alcohol storage room. They have like 5 months. They have like $60,000 worth of booze in the alcohol storage room.
How do you get people to understand they need to do something that takes away from sort of like one of their dinners out a week?
We spend so much time on education. We have our own podcast. I write a quarterly newsletter. We're going to have an investor symposium with 400 of our clients in the month and a half. Tremendous amount of content around education.
Welcome to the Futures Edge. I am Jim Iuorio. That's Bob Iaccino. Today we have as guest Jeff Sarti, who is the CEO of Morton Wealth in Calabasas, California. Before we get to the housekeeping of our sponsor, what's the weather like in California right now? Is Calabasas one of those places where you barely need heat and you barely need air conditioning, or no?
You guessed it right. It's perfect. No complaining
awesome
here, without a doubt.
Yeah. My daughter, when she had an apartment outside of Palo Alto, she didn't have heat or air conditioning. It was beautiful. It was awesome.
Yeah,
Anyway,
I lived in Pacific Palisades for 4.5 years, and the house I lived in burned to the ground.
Wow.
Yeah, burned to the ground. I needed,
in the fires. Oh,
yeah.
wow.
I mean, I wasn't there, obviously, but
No.
I mean, I needed heat more often than AC
Interesting.
in that area.
Yeah. God, we are sweating our nards off here, which, by the way, that's why I couldn't run for lieutenant governor, because I say things like nards way too many times.
You're in
They
Florida,
can hold
right?
that against you, right?
You're in Florida, right?
No, I'm in Chicago.
You're in
I'm in
Chicago. Got it.
I'm in
He's in Florida. Before we start, I forgot a couple different things. Please join myself, Bobby, and Mike Arnold at the newsletter, The Unfiltered Investor, unfilteredinvestor.com, where we take a lot of the things we talk about in this show and break them down into more minutia. We'd like to call out to our favorite sponsor. We all complain about how big corporations have taken over the food supply, because they have, but we're not helpless. There is something we can do, and we can patronize small independent farms that do things right. Independence Arc Farms in Arkansas. Grass-fed, grass-finished, farm-to-table, a small ranch. Talk to Marco. He will set you up with beef. Jeff, do you eat a lot of meat?
Eat a little bit of meat, but I love the independent farm stuff because
We're going to
just
try
my
to talk you
tomatoes
into
are
more meat.
meat. My
Yeah, I gotta
homegrown
tell you
tomatoes are
what.
going crazy right now.
Oh, my
I
God.
had a skirt steak from Marco at Independence Arc Farms. You open up the packet, and there's 2 skirt steaks in the packet, so it's not just one in there. And threw it on a flat top grill with, the Latin people call it a plancha. And that thing was off in like 5 minutes, and it was, crock
Fabulous.
cut, of course. It was unbelievable. The flavor was just out of this world.
Yeah. And the tenderloins that he sends out too. I mean, I have dreams about them. They are absolutely fantastic. But Bob, Jeff, sometimes on this show, we talk about finance and markets and stuff too, not just meat and weather. It's like a regular finance show, except we joke around a lot. No, like every other podcast. Just kidding. Jeff, tell us a little bit about Morton Wealth before we start.
Sure. First of all, nice to meet you guys. Thrilled to be here. Been, following you guys over the years back in the CNBC days, and really big fan of what you guys do.
Never heard of that. What's CNBC?
Yeah, we don't talk about that.
Long last channel.
I'm just kidding. I was just...
The
So
TMZ of financial media.
So we're a wealth management firm, been around for a long time. I've been with the firm 20 years, but the firm's been around since the early 90s, managed a little over $3 billion. And what do? We typically play the financial quarterback in our clients' lives. So that's, of course, going to be everything from retirement planning, involving cash flow planning, tax strategies, insurance, you name it. But really, our biggest differentiation is on the investment side, where we do things very, very differently than most in the traditional world. So, of course, we're going to have some stocks and bonds in portfolio, but we're going to have lots of other things. And the main reason why is we think diversification is widely misunderstood. And with each passing year, given a lot of what I'm sure we'll talk about, recklessness in the markets, both on the monetary and fiscal side. We need to protect portfolios. We need to build more resilient, diversified portfolios. And so that's what we do.
So to Jeff, it's just amazing to me how like we're in a situation where we have to beg, borrow, and steal just to maintain purchasing power with the irresponsible dollar policies. So like people are like, well, I completely understand why people get over their skis from a risk standpoint because they're constantly fighting that. So we're just caught in this nasty situation where you're fighting so hard to remain solvent and relevant and keep your purchasing power, and then all of a sudden you're on one side of the boat and you get turned. By the way, we had a nasty down day today. I know we're coming live on Rumble and Twitter, and this is going to be for both Jeff and for Bobby. Is this a big turning point, or is this nothing, just another one of those buy the dips?
My quick answer. Well, you go first, Bobby. Go ahead.
Well, what's your time frame on that question? Because
Well,
like for somebody like,
I
for somebody like Jeff, I'm sure with the clients of his that are like, hey, I want to be an aggressive in an aggressive portfolio, this is a great opportunity, right? But I will say that, and then I'll hand it over to Jeff. We have entered the worst seasonal period for stocks. The worst seasonal period for stocks is about the second half of August to right around options expiration in October. So seasonality is, I mean, that's what's playing out right now. It could be more than that, but we'll see.
Yeah, no, I agree with you from a short-term point of view. Probably atypical for a lot of your guests. We don't play much in the way of zigs and zags in the markets to too high of a degree. We're more of a long-term focus. And from a longer-term focus, we're looking at valuations, et cetera. We could talk more about that. But more on an intermediate-term factors. We think the market's, I won't quite say frothy, but listen, it's been quite a run since Liberation Day. There's just excesses in the market. And so potentially this is just a kind of standard shakeout. I'm not giving much more thought to it than that. So I think it's just kind of a standard.
Bobby, I was looking at the 5-year weekly chart, both the S&P and the NASDAQ. And there's one thing that I noticed is that, and we look, Jeff, our process at Unfiltered Investor and Path Trading for Bobby and Mike is the eight period and the 21 period moving averages, which have been very, very amazingly telling and great signals for us. The spread between those two, Bobby, was the biggest I had seen it been in years. When the spread between the 8 and 21 gets big, is that something that sends off bells to you? Because it did to me, and I bought some extra puts.
So what it does for me is, and again, just for everybody watching, these are the 8 exponential. So it's the 8 period. So if you're looking at a weekly chart, it's an 8 week. Okay, if you're looking at a daily, it's an 8 day. If you're looking at a monthly, it's an 8 month. And these are the exponential moving averages, the 8 and the 21. When they widen out after an early cross, it's a good sign. We don't buy the crosses. We don't sell the crosses. But when they start to move on a sharp angle and widen, and then the market dips into those areas, that's where the name rotation zone comes from, right? In most assets, 5 trips into the rotation zone, and the signal starts to weaken pretty dramatically. Stocks, it's more like 6 or 7. Just because stocks have a natural upward bias from people who are just like, I buy every dip. And there's a lot of long only mutual funds that still do that. So I don't look at it starting to widen, getting really, really wide as a signal, but I look how many times it's entered. And generally when it's getting that wide, it's entered or tested that zone a bunch of times where the signal starts to weaken.
So that's what would be the weakness. And by the way, you guys who are listening to this saying, well, it's like, they just found some random indicators. No, it's an indication of short-term momentum versus, slightly longer-term momentum. It's a very, very real signal. Jeff, let's say someone comes to you who's 40 years old, 25 years to retirement, and says, I am not particularly that risk averse, but I want to get 8% in the market. What do you do for that person?
It's a great question. The starting point is we're going to diversify across a lot of asset classes. So stocks are one of many asset classes. Bonds are one of many asset classes. Both we will be underweight and potentially massively underweight. And again, this is just more from a long-term valuation point of view more than anything else. Stocks trading, at or near all-time high valuations, depending on what metric you look at. Bonds, if you asked me that question, 5, 6, 7 years ago, I would have said, avoid it like the plague. Now at least yields are up a little bit. So there's some selective opportunities in bonds. But long story short, on those two asset classes, instead of it being 60-40, those should be, pick a number, 20-15. So that's another whole 2/3 of a portfolio to play with. One big thing we do, and I know we share this passion, I share this passion with you guys, is
gold.
It is gold.
I knew you were going to say it.
We've been a long time believer in gold. But we really implemented our portfolios going back as far as 2015. Whether early, timing's always tough on these things, but we've had long-term concerns around monetary policy, 0%, QE, money printing, you name it, around the globe. And then hypercharged with fiscal policy in more later years, that we think gold just has to be a core part of the portfolio. Where we, to some degree, supercharge that a little bit, there's a lot of ways you could do it. You could do it with other metals, you could do it with crypto. Our tool of choice has been in mining stocks, in gold mining stocks, which have been a tricky one, right? It's a feast or famine in the mining stock world. That being said, we've tended to trade it pretty well. It's a smaller position compared to our gold, but that of late has done very well. And even with the tremendous performance, there's still potentially some good upside. I mean, it's one of the few sectors of the market that is earnings year. I mean, they're just printing money, these companies. But then lastly, and I think maybe where we'll spend some of the time, where we spend a lot of our time, call it with the other 40 or 50% of the portfolio, it's in private markets. It's looking for avenues to get, knock on wood, stock-like returns, but at much reduced risk. And there's a whole world of investments outside of the public markets. They come in all shapes and sizes. Many areas are in the news right now, and they're becoming more crowded, without a doubt. A lot of bad things happening in classic private equity, private credit land. We could spend time talking about that too, but we're typically really in niche areas that I think are resilient in the face of some of those headwinds in the private markets.
Jeff, what do you think? I'm going to put something up, and this is from our friend at Invictus Research, Mike Singleton. And for the record, he is not a money manager. Okay. He runs a research firm. And this is a portfolio of 60% stocks, 40% gold versus just the S&P 500. And so you can see the blue line, the bluish line below the white line, that is stocks and gold. And the one above it is just the S&P 500. And it's got a compounded annualized growth rate, CAGR, for people who don't know what that is. The mixed portfolio, 8.4%, the S&P, 9.2%. That's since 1975. And if you look at the Sortino and the Sharp, they're comparable. In both cases, the mixed portfolio is better, and the max drawdown is better on the mixed portfolio. When you see something like this,
the max drawdown is significantly better on the stocks versus gold. No,
Right.
I'm just looking at it. I just want to make sure people know what we're saying. Right. Okay, good. Yeah.
And the reason I wanted to put this up is, and again, Mike doesn't manage money. If you guys want a good research firm, Invictus is a really good one. They're a retail focused research firm.
They're amazing. Yeah.
When you look at this kind of a thing, why do you think some money management firms shun gold? Is there any reason why that would be? Is there some sort of a fee advantage for people to like sort of shun gold? What would it be?
Listen, I mean, this is the $1 trillion question, right? To some degree, if you ask, even with believers in gold, I think if you ask 100 people in the room their view on gold, you're going to have 100 different answers. Mm-hmm. That's the challenge of gold at its core. And listen, I am a believer in gold and have been so for quite some time. But at its core, all it really is a pretty shiny rock. I mean, I do acknowledge that. That being said, it's a pretty shining rock that has withstood the test of time. It's been a store of value and an alternative currency and all the things that I think we share that belief on. But we have been, I think, to more succinctly answer your question, why most traditional managers have truly 0% allocation to this space is for a couple reasons. One, they really haven't needed it, even though, yes, on a risk-adjusted basis, that chart jumps off the page. Most really don't look at risk adjusted. They're just looking at total return. And if we've been so blessed with a declining interest rate environment, the last 40 years, stocks just only go up, right? It's always buy the dip and they keep going up. So there's really been no need to own gold. Coupled with, there were some real, tough periods in gold. And these were a good example where, potentially, and those were even valid, right? I'm not a gold bug where I think you need a ton of gold in all environments, but some environments you need it more than others. And now in particular, and we made a decision really starting in 2015, we had no choice that we felt you really need an insurance policy to protect against on the downside to maintain purchasing power. One last point I'll make, this kind of goes back to how spoiled we are in the last 40 years.
How spoiled we are. But anyway, yeah.
Most investors think, as long as you hold stocks for the long term, you'll be fine. And that's generally true. But I actually polled a handful of friends and clients recently. I was like, what define long term? What do you mean by long term? Most say, the answer was typically most in the, call it 3 to 10 year range. Like as long as you hold stocks for 5 years, 7 years, you should be fine. 10 years was kind of the extreme. The reality is not necessarily true. I mean, if you just look back, let's say at the last 100 years, you could break it down into 3 30-year periods. And in each of those 30-year periods, you had roughly each of those periods, you had a 10-year period where stocks were flat. I mean, obviously underperforming inflation. So 1929 to 1943, 1966 to 1974, actually took until 1982, 16 years to break even with inflation. And then the lost decade of the 2000s. My point being, I'm not saying you don't own any stocks, but man, stocks really have to be up. When I talk long term, I talk more than 10 years, 15 years, 20 years. So those who are just buy and hold, which most investors are, I know you guys trade in and out, but for most investors who are buy and hold and it's an allocation, they have to think of their stocks as a volatile asset. Some of them shy away from gold because gold is volatile. Stocks in many ways are every bit as volatile, if not more so.
So with that in mind, I'm sure you heard Florida, where I live now, left Chicago almost 5 years ago now. And I live in Florida, and Governor Ron DeSantis signed a law that called gold and silver actual legal tender in the state of Florida. So it's now designated a legal tender. So as a fun thing, when I lived in Southern California, I used to go to Ralph's. Down here, it's Publix, right? So I took a gold coin that we have in the house. It's next to my guns and dogs, people. But I took a gold coin that I have in the house, and I grabbed a pack of gum, and I went to Publix, and I put down the gum, and then I put down the 1 ounce gold coin. And the girl looked at me like, I'm sorry. I'm like, it's legal tender. I need my change of $3,244.68. And we called the manager over, and he's like, come on, dude, what are you doing?
He's right. I side with him, to be clear.
And I was like, I know, that's fine. So I took the 2 singles out of my pocket, and I paid for it.
Yeah.
To me, that is the difference between gold and crypto. Now, I'm not anti-crypto, and you mentioned crypto. I'm not anti by any stretch, but I do trade it more than I hold it, and I hold a lot more gold. And the reason for me was 5,000 years of it being a currency, number one. Number two, and I'm not a gold bug either, although, Jimmy, I'm going to be speaking at a symposium on a panel, anti-Bitcoin, pro-gold. I'm a little nervous about it.
Okay.
But my stance is basically this: gold actually is currency in a lot of places, and China and India, two of the absolute largest cultures in the world by population, still consider it to be one of the most valuable things on the planet. Where do you fall in gold versus Bitcoin, or do you just say what most people say? I like both.
So I lean more towards gold than Bitcoin. For our clients, I'm more pro Bitcoin than not. So I'm not a Bitcoin hater by any stretch. But we have decided for a variety of reasons to solely allocate to gold and not have an allocation to Bitcoin, at least to date. Part of that is I do believe there's a world going forward where both can win. There's a possibility and that is one of the risks, by the way, to gold. And I do think about this. Potentially, do I have the right view of the world, but the wrong vehicle? If Bitcoin ultimately is the digital gold, I still think even if that happens, we're far, far away from that. So I do understand those that believe in Bitcoin and or own both gold and Bitcoin. But listen, there are pros. Bitcoin lovers obviously point to the decentralization, the digital nature of it. There's the technology. There are tremendous benefits, but there are benefits to gold that potentially Bitcoin doesn't have. Bitcoin fundamentally is actually being a technology is potentially its weakness. Something can potentially come in, we don't know, and replace it. Do you use your imagination? It could be anything. It could be something else 10 years from now that we've never even thought of that is a better mousetrap than Bitcoin. We all know of the need for a functioning society. I'm mainly talking about electricity, technology, et cetera. If you have a shutdown of that, gold will obviously be much more value than Bitcoin. Tremendous unknowns around Bitcoin, around hacking and quantum computing, et cetera. That again, we don't really know. We don't know what the future holds. Long story short, we're more passionate about gold than Bitcoin, but I understand. I think there's a place for both. One last point, just real quick to make, going back to your last question on why people don't believe in gold. I was just kind of to one thing to think about finishing my point. It comes down to a view of the world. Most have a view of the world. Again, going back to how spoiled we are, that policymakers, and I'm not just talking here in the US, but around the globe, they have our backs and there's a put. There's a put to the market. And they will always save us. And listen, that's been right. That view of the world has been right. So with that view of the world, if the next decade looked like the last 40 years, then you know what? You don't really need gold. I believe at a certain point there is no free lunch. And if more of the same of these come to the rescue type policies keep happening, actually at a certain point, the market will wake up and name what
The dollar
happened.
will get hammered, right?
Exactly. And so that until that happens, I think really, I don't know if the West, North America, Western countries in particular will really wake up to gold. Truth is by then it'll probably be too late.
Yeah.
So, yeah.
But just several different times you've mentioned as a reason to hold gold and Bitcoin as a hedge against poor stewardship of fiat currencies, which I
Yes.
think is a fantastic reason, but I only think that's 80% of it. And I want to mention two more and have you comment on those. Because one of the reasons I own gold and increased my allocation to was when geopolitically global central banks started buying more gold than they had in the past. And then two, I think deep down, it's a small percentage of people who are starting to have the fear of central bank digital currency and a system that you can be surveilled. And when you hold gold, you can't be. Do you like those two reasons?
Yes.
Yeah, well, that's a short answer, but yes.
Absolutely.
Okay. Yeah, I like that too.
Absolutely. Yeah, those are both great reasons. Yeah, the whole digital. Listen, I feel like Bitcoin, again, most Bitcoin lovers would say that Bitcoin falls out of that realm of you talk about digital currency, but digital currency, whether Bitcoin or whether government controlled at a certain point, to your point, surveillance, true control.
Yeah, I've argued
The
for
benefit of
years.
it being a shiny rock is it truly can be in your pocket and in your safe.
Bingo.
Right.
And then there's no counterparty risk. And again, this, if anyone who thinks I'm a crazy conspiracy theorist, since the dawn of man, governments have tried to control their people. The only thing that was left and they couldn't do was the ability to constantly surveil. Guess what? We have arrived. If it doesn't scare you, well, then you're alone. Bob?
Well, I'll tell you something real quick, Jimmy. I sat down with the guys that are running this symposium because they both live down here. And it was really funny. I said, my partner, my co-host, his theory is Satoshi is the CIA. And he goes, that's not an uncommon theory. And then he said his partner has done a lot of work and thinks he knows who Satoshi is. So this will all be very interesting. By the way, a couple of his crypto buddies are going to come on the pod in a couple of weeks. So
That's awesome.
but anyway, I got to ask you about something that people have been asking me about a lot lately, Jeff. And it is Universal Index Life.
Mhm.
Now, I don't know how much you know about it. You can say, look, that's not my wheelhouse, whatever you want. But lately, and I know Jimmy gets this too.
Yeah.
Jimmy and I are active investors, but we also, both of us have been around 30 plus years. And we were both CNBC guys. We were both Fox guys. Jimmy still is. And, we know a lot about a lot of things. And I know enough about this to tell people it is something I would do. It isn't something I would
Yeah.
do if I were you. What are the advantages and disadvantages? As a matter of fact, I said to somebody yesterday, he's like, yeah, the guy wants to charge me $400 a month for this. And I'm like, you could also just put $400 a year in the NASDAQ.
Yeah.
But go ahead.
Listen, I'm going to paint it with a very broad brush. And truth is, I only, others in my organization know more about this than I do. So just my high level thoughts are in certain unique circumstances, there are reasonable use cases where, insurance, it's appropriate insurance coupled with the appropriate investment vehicle in a wrapper friendly way. Generally speaking, though, they're very fee laden. You don't have much in the way of real flexibility that we like with the underlying investments. So we tend to avoid them for those reasons. And again, we have so many other vehicles beyond stocks, bonds, gold where we can allocate that we just spend our time in other areas. So somewhat of a non-answer, but we lean in other areas.
Can I ask a quick embarrassing question? Because I went to retweet on Twitter and I don't know what the hell you guys were just talking about for the last 2 minutes. What were you talking about?
Index Universal Life.
Okay, got it. Okay, so Jeff, and I do want to get to some of the current time here. We're sitting at a very, very interesting spot with the Fed, with potentially interest rates and the liquidity trade that we've set over the last 40 years. But before we do, what you mentioned kind of a private equity. Is that what you call it? What you do with a lot of your firms? So what is like a perfect investment? Do you guys buy companies? Is that it?
No, no. So no, we do virtually none of that. So our main area, we do a lot of different things. So everything, a lot of real estate, a lot of
Well, just then
company.
profile one that you like a lot right
Yeah,
now.
so I'll stick with our bread and butter right now in this environment. We do a lot in the private credit space, so private lending. Private credit, as you know, has really exploded a lot in the last years. A lot of money chasing it, with the end result of being standards, covenants have really deteriorated. We don't do that. The lion's share of private lending, which we don't do, is lending to corporate America. It's a proxy for high yield bonds. You're lending to corporate America. Hopefully, your covenants are pretty solid, but you're just along for the ride. All you're lending on is with the hope that a company does well and it has the cash flow to support that loan. The problem with that investment is you're correlated with stocks. High yield bonds look more like stocks than bonds. Yield spreads are tight. And on top of it, as I mentioned, because there's so much competition in the marketplace, covenants have continued to be weakened in recent years. What we do is very different. We lend on a variety of different opportunities, but plain vanilla example is lending to companies, but in a very different way. Being to some degree agnostic about their cash flow, it's focusing on assets as collateral.
Okay.
So just for the same reason we talk about we love real assets in general. So gold is a starting point. I know you do other things in other precious metals, et cetera. We love real estate. But so when we're lending to a company, and let's say a company's fine and are making money and growing, but if they have a large trucking fleet that we can lend on, and we will own the keys to that trucking fleet, we own that collateral, and we have a healthy margin in terms of safety, loan to value, that even if that company goes out of business and we have to fire sale that trucking fleet, we're going to be fine. So a lot of what we do, and there's a plethora of these types of opportunities for a few reasons. One, regional banks have left a vacuum with Silicon Valley Bank, et cetera, from a few years ago. But the most important thing, and this has been longer than just the Silicon Valley Bank phenomenon, 90+% of lenders, they do what's easy. What that means is they look at a company's balance sheet financials, and then they make a loan that could go through the underwriting department, and then they make a loan based on those financials. If there's a little bit more hair on a company, they'll just completely avoid it. To do the work, to go in and appraise a company's inventory or trucking fleet, in my example, that is a lot of work. You really have to roll up your sleeves. You have to have real expertise. Most lenders would rather just make money in a simpler way and move on to the next loan. So asset-based lending is a huge part of what we do, because our goal is, again, to be agnostic to the health of the company, and then even in downside scenarios, be paid.
So one thing is funny is that I'll just tell a quick little anecdote. When we bought the restaurant I own, Branson Palatine, 13 years ago, 12 and a half years ago, we bought it. And the land was worth, it was 2.5 acres, and it was worth about, let's call it, million plus. The business itself had been run into the ground. They threw that in for like 35 grand. Now the standard in the restaurant business is that you keep about 2 weeks of alcohol in your alcohol storage room. We all of a sudden open the room, the alcohol storage room. They have like 5 months. They have like $60,000 worth of booze in the alcohol storage room that we just bought this company for $30,000.
Totally.
I mean, it was everywhere. It was bottles and bottles and bottles. Like, Jesus, are these people morons? And 50,000 might have been a little bit of an exaggeration, but it was a whole room full of crap ton of booze. But Bobby, I didn't mean to. I just wanted that story. So again, assets. I love assets. Particularly booze is one of my favorite assets.
And if you have cushion, it goes back to our view of the world, some of the starting point of the conversation. We want to be in things that are resilient, that if we hit a speed bump in the economy, will be protected, and then to some degree are just kind of outside of the system. That trucking fleet has nothing to do with what Jerome Powell's going to announce tomorrow,
Right.
At Jackson Hole.
Ooh, boy, that's a great tie-in. Now, you just did it. You're a journalistic genius. That's what I wanted to go to. Jeff is the man. I'm sorry. I just got excited there.
No, it's okay. That's actually where I was going. I was going to
That's
say,
good.
I saw you smile. That's why I jumped in.
yeah,
Right?
I'm going to put you on the spot a little bit. First of all, do you think that Jerome Powell is being political? And I want to say something before you answer. Jimmy and I have almost a direct line to Jerome Powell, not to the point where you could tell us and we could insider trade, not that
Yeah.
kind of. I'm just saying, a guy who knows a guy that went to college with him and described him as one of the most sort of go right through the brick wall if you tell him he can't kind of people.
Mm,
And I think you saw that with the little back and forth with him and President Trump when they were touring the building. Well, it's a building that's being built. Well, it's still a building. Yeah, but it was in the other budget. Yeah, but it's still in here. And they're just going back and forth. It was literally like they were going to start pushing and punching. It was amazing.
yeah.
God,
That
I
was
paid to
great.
see
That
it.
was great, by the way, that
Yeah, that
minute
was
together. That
great.
was awesome, awesome television.
So, do you think that he is being stubborn or being correct in not doing anything yet? And I think actually got Jackson Hole in his speech on Friday. I think one of the most important and interesting things is going to be the FOMC minutes.
Yeah. I'm pausing because my head turns on this one. My quick answer, I do think he's somewhat political. I don't think to a massive degree, but listen, I can't even blame the guy, right? I mean, Trump is asking for him to be going back to his previously. I mean, criticizing him tremendously left and right. Powell also disagrees with many of the policies. And so he's facing an uphill battle where he feels he has to manipulate interest rates to fight that battle. That being said, at its core, what I believe drives Jerome Powell, as would anyone, is his legacy. So, yes, I think he is going to be a little bit politically motivated, but more than anything, I think he cares about avoiding a calamity or a crisis but in the next 8 months before he's out in May. So I do think he's political, but I put probably less weight into that than most. He cares about his legacy, as I think most anyone in that position. It's a shame to say, but that's really what most care about.
No, I agree. And I think that a lot of it's ego driven too, Bobby. But my question to you then, Bobby, is that we're going to hear him on Friday. Okay. If he starts to talk dovish, then it's perceived possibly as acquiescing to the president's pressure, which I don't think he wants to be perceived that way at all. And again, no one does. And maybe that's far down on the list, and the legacy is definitely number one. But do you think it is just going to be an absolute non event, just data dependent, yada, yada, whatever?
I think he's going to be dovish. Now, I think I'm probably alone in that.
No, I agree with you. Sorry to
You
interrupt. I
agree?
agree.
No, please.
Well,
agree.
no, we can interrupt all
you
time,
go
and I want to get
first,
both your
and then
opinions
I'll
as to
follow.
why. But
Yeah.
Bob, go. Yeah.
No, I'll follow you. Go ahead, Jeff. Why do you think he's going to be?
I think, listen, to some degree, the data of late, the employment data in particular, was borderline nasty. I mean, some of those adjustments were nasty. I think, again, he has a short window here that, let me even back up a little bit. All of these, going back to Greenspan, they all are dovish. It's in their DNA. Jerome Powell is no different. They want, at their core, they are Keynesian. They want to ease. Again, it's in Powell's DNA. He didn't raise rates. I don't even, what was it, 2021, 2022, until inflation hit 8 or 9%. Interest rates were still 0%. I mean, this is an utter failure. So he's already shown his inclination. Now, don't get me wrong. Now I feel bad for the guy. Backed into a corner. Tough position, both politically, but now inflation's sticky. So it's not quite so easy for him to ease. That being said, is he just more dovish? Would he like to be accommodative versus Volcker-like? From my point of view, no doubt. He's already shown it. Dovish.
Well, I wrote a Substack on mine and Jimmy's Substack about R*, the neutral rate, and I think it's quite a bit lower. And the subtitle to that article was "Proving Independence Sometimes Means Agreeing with Trump." Now, not about the level of rates that are needed. I think saying, even Scott Besson, who I think is one of the smartest financial guys out there, saying that, that they should do 50 right away and then start a series. I think that's too much.
Yeah.
I really do. But what I view this as is the Fed, Jimmy, is being forecast dependent, not data dependent.
So do I.
Yeah. And that's they're saying there might be inflation from the tariffs, therefore we should hold rates. And it's another thing I'm stealing from Mike from Invictus Research. Annualized inflation on the goods side is about 1.1%.
Yeah.
So the services side is still hot. But I think that's likely to be sustained simply because we're deporting cheap work and we're going to have to hire people who are more expensive. So I think wages are going to start to finally catch up and it might actually help people. Jimmy, am I nuts?
No, you're not. Not only are you not nuts at all, I like every bit of it, but I'm going to add something to it. Let's say that Jeff, Bobby, and Jim were the head of the Fed right now. Okay. We have a very, very accurate mechanism to tell us if we're right or wrong. The problem is that the Fed doesn't like to go back on what they just did for fear of the way they look. As long as we agreed that we don't give a shit the way we look, and Jeff, Bobby, and I have been traders for a long time. And I'm going to get to what the mechanism is. And when we are wrong, we have to reverse quickly, or else we're not going to be long in the business. If you have a big ego and pride that says, no, I'm right, you guys are all wrong, well, then you're going to be driving a truck pretty soon. Maybe one of those trucks that you repossessed from that company, perhaps, just tie it together. However, the mechanism, he's on a roll, just let him go. No, the mechanism is the 10-year. And we lowered rates 100 basis points from September to December. 10-year yields shot from 3.6 up to 4.7. The 10-year yield was looking the Fed directly in the eye and saying, you are wrong. This is the wrong time to ease rates. That being said, the three of us could say, okay, let's do a 25 basis point cut. One of us be watching guard on that 10-year for the next week or so to see what the 10-year says. If it says you're fine and yields go down a little bit in the long end, it'll mean the market is telling you. So again, you can use the value and the smart money to your favor. Bobby, am I crazy about that?
No, I think that's right. And that's why, again, I think Jerome Powell knows this. I really do. And I think that he has held the course long enough. He doesn't want to be the first Fed chair to go through a meeting and have it be I don't remember how many voting members there are, but have it be 8-7.
Yeah.
You know what I mean?
Yeah.
He doesn't want to do that. He already had 2 dissenters. That was the first time in 30 years?
Yeah.
There were 2
Which
dissenters.
again, those two are both, and Kudlow yelled at me for giving this opinion. Those two are both auditioning for the Fed.
They
and
are.
Larry was like, no, I know these guys. They're good. Whatever. Right?
I'm not saying they're bad guys.
Yeah, no,
And
I'd
they're not
audition for the
actually
Fed too.
believe
You
it.
want me to dissent? It's going to have no effect except for make me the prime suspect for Trump to a point. Anyway, go on. Yeah.
No, that's why I think he's actually going to be dovish. I think he knows this. I think he knows that, we're basically sitting at full employment, but the picture of that is a lot easier to read in the short term than the inflation picture is.
Yeah.
So,
Jeff,
and
any
I've said
comments
this
on that?
before. I mean, I think tariffs are a tax, not inflationary. To me, they can't be both. And taxes are deflationary, Jeff.
I agree. I think he's looking ahead as most are, even those who are even to some degree pro-tariffs, where there's an acknowledgement that there potentially is going to be a slowdown that is going to happen as a result. And so, Powell is going to get ahead of that. I agree with you, Jim, too. I think the most important thing is the 10-year. That's interest rates, and given our debt levels, and that's a sign of the strength of the dollar in the global system, the confidence in the system. And it was a real unusual situation when we lowered rates, and then the long rate went up.
Higher.
That's one thing that concerns me about Besant's comment, where when he's talking, oh, it should go down. And Bobby, you hit on this. Yeah, I agree with him maybe a little bit, but him saying 150 basis points, what can happen? What will happen at the long end? I mean, that could be, listen, who knows, knock on wood that everything stays calm. But is that where you have, what happened in Britain 2 years ago, where the long end of the curve just gets completely
The Liz Truss moment where the bond market fired her. Anyway, Bobby.
And there's 2 things that are happening right now that I think are interesting, and I want to get both your opinion on that. Jeff, you just brought up the long end. This is the first time in, I want to say, 50 years where it's cheaper to rent than to own. And it's the first time, I believe, in our history, but don't quote me on that. I believe it's in our history that buying a new home is cheaper than buying an existing home. That's something that our friend Danielle DiMartino Booth posted on X recently.
She's awesome.
And yeah, she is awesome. With those 2 things, I don't think, I know Besant knows this, but I don't know if President Trump does, honestly. And I'm not trying to knock him. I just don't know if he knows. I think the long end rises if they cut rates too much. And that's not going to help the housing market. Am I wrong?
No, you're not wrong at all. As a matter of fact, that's why the 150 basis point thing is fine as a 6-month, 8-month goal, if that's what you want to do. Because like you said, the R-star, the neutral rate, we all believe is lower than here. But you don't get there with one axe cut. That's asinine. That would be disruptive of markets. Jeff, you agree?
I do. I think, listen, this is the rules of the last decade are different now going forward. Inflation changes everything. And I do agree with you both that, at least over the short term, it feels like inflationary pressures might be more disinflationary as opposed to inflation, if I had to guess. That being said, we're 3 years, 4 years into, I mean, what, prices up cumulatively 30, 40%?
Jesus
So the
Christ, yeah.
pain's already happened. So yes, if rates even come down to 2%, we still have a lot of catching up to do to some degree. We need lots of
Wages.
low inflation rates to get back to normal. So inflation changes the landscape, and so much of it is just our debt levels, our insurance, our interest costs to service that debt. We are in a real tough position, and that's why they want to lower rates. They want to fix a lot of these problems, but the risk of lowering them too much is that's where things can really unravel.
We got a question from Tim, who watches both of our shows, Jeff, and he's also in commercial real estate down here in Southwest Florida. He's a friend of both mine and Jim's. Very, very smart guy, especially in commercial real estate. He says, do you guys think a few 25 basis point rate cuts will make a substantial difference in the U.S. economy over the next 12 months?
The only difference I see that's going to be big is if it's 50 basis points and the Treasury is going to primarily be selling bonds on the short end, much like the Treasury before them. So it will save some interest costs. Jeff?
It will, but I think people are talking about that a lot. I think it's a rounding error.
Yeah, probably.
I just
But
don't.
will it make people borrow more?
Again, that's a hope. Listen, we do a lot of real estate, and there's so much hope in the real estate market that they want rates to come down to grease the system again and open lending back up. My instincts tell me no, that won't happen. I don't think they should lower more than a quarter or so, as you guys alluded to as well. But then the flip side is only a quarter, even a half.
Yeah, does it
I
even
don't
do
think it's
anything?
I don't think it's gonna juice things in terms of the refinancing market.
No,
Tell you what
I
I
would
think.
the only reason I'm saying a quarter is that I think you got to start slow, see what the reaction is, because the market will tell you how
I
low
agree.
you can go. Yeah.
Timmy, I think it'll give a short-term boost to the stock market,
Yes.
not Main Street. I don't. I mean, I know there's no, these stresses people talk about, even when like the credit card debt is creeping up, it's nowhere near troubling levels.
Agreed.
It's creeping up. Student loans, I don't even know what to think of student loans anymore, because after they got all those hiatuses from paying, a lot of them just don't want to pay anymore. And they're like coming at me. So I don't even know what to think of that. And I think Timmy would agree because he watches real estate pretty close. I have not seen an absolute tidal wave of foreclosures yet.
No.
So I don't think it's helping the economy, because I don't think there's anybody that's hurting that needs it. So I think the three of us agree on that.
Yeah, I think.
And then go ahead.
Go ahead.
Sorry.
No, I was going to say, I think you'd have to go 100 basis points and then at a 4-month lag to see any sort of people who are like, oh, this is good. I'll start borrowing money again, or I'll do CapEx and shit like that. Yeah.
One follow-up to Bobby, your comment. I agree with you. I don't think it'll help Main Street. It's not that much. But then counterintuitively, you said it'll help the stock market. I agree with you, but isn't that kind of twisted? I mean, this is part of why we are just underweight stocks as an asset class. It's just become a liquidity game, financial engineering, passive investments, driving flows. It's a flow game more than anything else. And that's just not, again, from a trading point of view, I'm not in your guys' world. I think you can trade that effectively. But from a long-term allocator point of view, as we are, that's just not an asset class with great fundamentals. It's being driven by the wrong things. Coupled with the starting point is, as I mentioned this in the beginning, valuations are expensive, very expensive.
It's fascinating.
So, Jeff, do you maintain that it is still earnings at the end of the day that will drive the success of a stock, medium to long term?
Man, I hope so. I used to think so. I'm not sure anymore.
What a great answer.
I am not sure anymore. I mean, we used to be, in our stock allocation. Again, it's light compared to any really other group that I know, but we've moved more in the passive way as opposed to active, because active management, you again think driven by fundamentals, earnings. It's just you know the data. I mean, it's rare that active management can be passive management. So that kind of is the punchline, that if active managers can't win, they don't know what drives stocks. So what does?
Jeff, but have you been underperforming as the stock market has been somewhat on fire? Which we understand.
Yeah.
Alpha. We are perfectly fine with risk-adjusted returns. But so have you been underperforming, and your investors are okay with that because they know they're a little more protected, correct?
Yeah. So I would say we've been, depending on the year. Listen, if the S&P's up 20, we're underperforming. But if the S&P's up high single digits to low double digits, the answer is no. We have not been, because these private credit areas and other areas of the market, coupled with gold and commodities and things we're on, are doing every bit as well on just a pure absolute basis. I'm not even talking risk adjusted. So that's one of the nice parts of these private markets. It's not like, oh, because we have a view of the world and we're conservative, we're going to bonds or treasuries. Anything but the sort. I mean, we're generating, knock on wood, stock-like returns at much reduced risk. But yes, in extreme markets where, the S&P's up 20, we're gonna lag. There's no avoiding it.
Yeah, this is something that, like, I agree with both of you guys here. And this is one of the things that I think about, something that I sort of want to evangelize for the rest of my life that I'm talking to people, is that you're not underperforming if the S&P is up 25% and you're up 23. And then the S&P is down 12% and you're down 4. You're outperforming. Right. And a lot of people, and this is what, you brought it up earlier, Jeff. It's like people look at it and they just basically index and they say, oh, I'm making more money than you. I'm better at this than you are. No, you're not. We've all lived long enough. Jeff, I think you might actually be younger than both of us, but we all live long enough to see at least 3 of these things.
Yeah.
Where everything collapses and then you lose a generation of investors because crap like CNBC is out there having a show called Fast Money.
Right,
Drives me crazy every time I see that. They used to have, God, his name escapes me now. CNBC used to have the guy who basically invented the buy and hold mutual fund. Can't remember his name, but it'll come to me before the
Peter
show's
Lynch?
out. And then they would fight. He's passed away. Bogle.
Yeah.
Bogle with a B,
Bogle.
right?
Yeah, he
Jack
passed
Bogle,
away recently. They'd do a 30-minute interview with him, and they'd go, now stay tuned for Fast Money. Did you just hear who you were praising? I mean, he used to drive me crazy. So it's something I want to evangelize for basically the rest of my life. It's like, look, beating to the upside is not the goal. It's beating to both. And beating to the downside is actually much more important. I don't have a question. I just rambled.
No, and I like it too. And that's why again, at these levels, this, Bobby, pretty much half of my stock allocation is somewhat hedged using options, particularly when volatility is low and they give away, which brings me to another question. Actually, there's 2 questions that I can't decide which one. One, I was going to talk to you about who can invest with you, like they have to be accredited. But 2, I was like, do you have any portfolios that use options on equities, things like that?
I'll start with the latter one. I actually have somewhat of an options background. So we used to do a lot in the way, especially pre-08, when interest rates were higher and vol was a little higher and more normalized in structured notes. So options like vehicles, we've typically gotten out of that. In post-08 or through the '08 timeframe, we definitely had a good amount of exposure to different hedge funds that did option strategies. Long story short, we've really moved away from that because the '08 crisis, what came out of that was so much in the way of through bank regulation, et cetera, that we find so many opportunities now in the private markets that on a risk adjusted basis, we just think can do better than that. In terms of our clientele, we manage typically wealth for high net worth investors. They don't necessarily need to be accredited, but ideally they are, because there are some, restrictions around being able to get in, SEC related restrictions about getting into certain funds, et cetera. But we have a few different offerings, even for those with lower net worths, typically targeting younger individuals. More, we just help get them on the right path, help get them in a more diversified portfolio than a typical robo-advisor or, name the name brand firm can do. But it's a little bit of a different model. That one, it's actually more of a retainer model. It's almost like having a concierge doctor, where it's less about assets. It's more about, hey, you need help in so many areas of your life, from buying or renting a home to, are you setting up a business, to you need to set up a estate plan. It's funny, financial planning, most people think, oh, that's for people in their 60s and 70s. The people who need the most financial planning help are the people that's starting out families, but they don't have the assets to be attractive to a financial advisor to target them. So we have a whole offering that targets them as well.
That's outstanding, Bob.
How do you get people? That's a great question. And I had a different question for you, but just struck a chord with me. Is I have a friend who is recently left a really high profile job in New York, came down here and started a little wealth management business. And so he's reaching out, obviously, initially to all his contacts, right? And he's amazed how many people in positions like me and Jim, for example, that have not done the right things for down the road. Now, I know Jim has.
Yeah.
You
How
know,
do you
and
know?
he
Just
talks to
because I
people
talk
and
like
they're
I have?
just
But anyway, go on.
whatever. Yeah. And they're just like, there's like, no, I just don't do any of that stuff. I got a guy, but I talk to him like once every year and a half.
Yeah.
How do you get people to understand they need to do something that takes away from sort of like, I don't know, I mean, one of their dinners out a week to prepare for their lives in the future? How do you get them to see that?
Oh man, I love how you asked that question because we spend so much time on education. We have our own podcast. I write a quarterly newsletter. We're going to have an investor symposium with 400 of our clients in the month and a half. Tremendous amount of content around education. And I know you guys are passionate around education too. I mean, our clients are super smart, business owners, doctors, lawyers, you name it, all walks of life. They were not taught finance in school. They were not taught this stuff. And the problem with our industry at large is typically what financial advisors are viewed as is someone to hand over the reins to. And then you as the client, you delegate, you delegate to them. I used to think when thinking about like the avatar of the ideal client, and our industry thinks the delegators to the perfect client, I've done a 180 on that completely. The best clients are those who are part of the process. They're willing to spend the time, to your point, Bobby, of the quote dinner a week. We typically touch our clients upwards of 6 or 8 times a year. I mean, we are talking to them all, and it's not like, a meeting going over your portfolio. There's some of that, but it's lots of touch points on a variety of different topics because there's a lot of life is complicated. So we don't want delegators. We want people who have ownership as a part of the investment process. We're asking them to do things very differently. So that's hard. Trust is not a strategy when you're doing something differently, right? You have to really understand it and believe it, or else it's going to fall by the wayside ultimately. So much of the time we spend on education. So we know that they really embrace our view of the world and they share it, or else it's not going to work for them.
I love that answer.
Got a
That's
real
a great
quick
answer.
comment from Tim again, Jimmy, if you don't mind.
Not at all.
Tim says, does Jeff think private credit is a potential problem?
Yeah, I think it's a huge potential problem. Again, going back, we have a huge amount of our assets in private credit. I do think it's hard to paint it with. That's like saying our equities are a problem, right? There are good equities and bad equities and everything in between. That being said, most of private credit is potentially a very big problem coming down, the pike, if you will. Just so much money is chasing it. As I think I mentioned in the beginning of this discussion, covenants without a doubt are weakening. I think there's just a lot of money chasing this stuff. So now, listen, there can even be another leg with Trump now talking about opening this up in 401ks, et cetera. That can be another push up for these things where there could be more legs to private credit. But it would not surprise me if you always think, what is going to be the next cycle? What's like housing in 08 or tech in 99? In the downturn, it could be private credit driven that I think potentially really hurts the market in the next downturn. That
That's
would not
interesting.
surprise me.
That's
We don't know
interesting.
the size of it. It's totally opaque.
Yeah.
It's sort of like derivatives in 08, right? We didn't know with AIG and Bear Stearns, we had no idea what true exposure was. No one still knows what the true ultimate exposure was. No one really knows the true ultimate exposure of these private credit books.
Yeah, I love that answer. By the way, this has been an eye-opening, enlightening conversation with me because I get excited about risk-adjusted returns, about mitigating risk. Everyone thinks I've been traders for 37 years. We love, let's roll the dice. No, I love hedge. I love to feel good and sleep good. And I think it's amazing what you guys do. And I definitely think that it will be many shows that we will probably talk about your product because I'm impressed with it. Tell them real quick how to get a hold of you, how to
Thank you. Really appreciate that, Jim. Firm is Morton Wealth. So, mortonwealth.com. I'm on LinkedIn, easy to find on LinkedIn, just Jeff Sarti. And then on X, I'm at Sarti Jeff, SartiJeff.
Fantastic. Bobby, got any last words? I play us out.
No, play us out. I'm good.
Please, you guys, by the way, we love
I
doing
did
live
have a
shows. You
last
guys know.
question, but I don't remember it.
Yeah, that's because of your age.
Yeah, pretty
We
much.
love doing these shows, these live ones, because we love the interaction with you guys. Thank you so much for all the retweets, all the DMs. Please join Bobby, myself, and Mike Arnold at the Unfiltered Investor. It's just unfilteredinvestor.com. Check us out for the newsletter. Bobby and Mike have been absolutely spot on with their technical analysis. Please check out our sponsor, Independence Arc Farms in Arkansas. Marco will set you up with excellent grass-fed, grass-finished beef. Remember, Bobby and I were in legacy media for 25 years. We kept having to to change our opinions based on overzealous producers and sponsors. We're not going to do that anymore. We're just giving it to you straight right here. Bobby, what do you got?
Tim wrote, "Why haven't I ever seen Jeff? He must be flying under the radar. Smart guy."
Well, no, that's what we're trying to fix right now.
Yeah,
Jeff's
we're
way
trying to
smarter
fix
than
that.
any of us, and he's flying under the radar. Guys like Bobby and I are flapping our gums. We got very little to say. Jeff actually knows shit, so that's why we're bringing him on our show. Anyway, thank you guys for being on with us on The Future's Edge.